$3,100. That was gold 6 months ago. Today, $5,000 per troy ounce. A 61% move in less than 200 days. COMEX open interest is behaving strangely. Shanghai premiums are diverging. And central banks just recorded their largest quarterly gold purchase in recorded history. Something is happening, and the next 48 hours may tell us exactly what. OG Anna AG here, sister of John AG. You clicked on this video because $5,000 gold either excites you or makes you deeply uncomfortable. Both reactions are valid. Both reactions can also cost you money if they override your analysis. This channel does not trade on emotion. We trade on data, structure, and pattern recognition. Today, we are going to run a full scenario matrix on gold at $5,000. Two primary paths, multiple sub-scenarios, macro catalysts, institutional positioning, historical precedent, and a bearish case that most gold bulls will not want to hear, but need to. If you are here to be told what you want to hear, this is the wrong channel. If you are here to think, stay with me. Let me ask you something before we go into the data. When gold hit $1,000 in 2008, analysts called it a bubble. When it hit $2,000 in 2020, they called it a pandemic anomaly. When it crossed $3,000 in early 2025, they called it geopolitical noise. At every single one of those levels, the majority of mainstream financial commentary was wrong about the direction. Now it is at 5,000, and the same voices are split, half calling it a generational bull market, half calling it the most dangerous bull trap since the Hunt brothers squeezed silver in 1980. Here is what separates serious analysts from noise. Neither camp is basing their argument purely on price. Price is a lagging indicator. What matters is the structure underneath the price. And right now, that structure is sending contradictory signals. That is not a reason to panic. That is a reason to build a scenario matrix, which is exactly what we are going to do. Let me show you what the data actually looks like. Start with COMEX. This is where Western institutional pricing is established through futures contracts. Currently, COMEX gold open interest is elevated, but not at historic extremes. What is unusual is the composition of that open interest. The managed money category, which includes hedge funds, CTAs, and algorithmic players, is net long at levels that historically precede either a significant continuation or a sharp reversal. When managed money is this concentrated on one side of a trade, the market becomes structurally fragile. Not because the thesis is wrong, but because any macro shock can force an unwind. And when leveraged players unwind simultaneously, price can move against fundamentals in a very short window. That is the mechanical setup that creates bull traps. But here is where it gets interesting. The commercial category, the banks, the producers, the entities closest to physical supply, is showing something different from prior cycle peaks. In previous peaks, commercials were aggressively short. They were selling the rally hard. Right now, commercial short positioning is elevated, but not at extreme historic levels. That divergence matters. It suggests that the entities with the most information about physical supply and demand are not fully positioned for a collapse. Now look at the relationship between futures price and physical market behavior. The COMEX futures price and the London spot price typically trade within a narrow spread. When that spread widens, it signals stress in the delivery mechanism. The physical market is behaving differently from the paper market. Data suggests that gold delivery requests on COMEX have been unusually high. The registered inventory, gold available for immediate delivery, has been under persistent drawdown pressure. This is not a new trend. It has been building for several quarters, but the rate of drawdown has accelerated. When physical demand is pulling harder than the futures market expects, one of two things happens. Either the futures price catches up to physical reality and continues higher, or the physical demand weakens, and the futures price corrects sharply downward to find a new equilibrium. Both are live scenarios right now. One more structural signal before we move to macro. The gold-silver ratio. At $5,000 gold, the ratio currently sits well above historical norms for a mature bull market. In the 1980 peak, the ratio compressed sharply as silver ran alongside gold. In 2011, similar compression occurred. The fact that silver has not kept pace with gold at this stage of the move is either a warning sign that gold is running ahead of itself or an early signal that silver is preparing a catch-up move that would confirm the broader metals bull market. Markets may be signaling that this bifurcation resolves in the next major move. The direction of that resolution is critical to the entire thesis. The FOMC is in an extraordinarily difficult position right now. Inflation has proven more persistent than their models projected. Growth is showing signs of deceleration. The labor market, while not collapsing, is softening in the leading indicators. This is the classic stagflationary setup. And stagflation is historically one of the most powerful environments for gold. But here is the nuance most retail investors miss. Gold does not simply go up because inflation exists. Gold goes up when real interest rates, the nominal rate minus inflation, are negative or falling. When the Federal Reserve is forced to keep rates below the rate of inflation, the opportunity cost of holding gold disappears. There is no yield advantage to holding dollars or treasuries over gold. Currently, real rates are in territory that has historically been associated with gold's strength. If the Fed is forced to cut rates while inflation remains elevated, which is one live scenario, real rates go more negative, and the structural case for gold strengthens significantly. However, if the Fed remains restrictive longer than the market expects, if they prioritize inflation over growth, real rates could move less negative or even turn positive. That is the macro headwind scenario for gold. The next 48 hours of economic data and any Fed communication could shift this calculus meaningfully. Beyond monetary policy, gold is currently carrying what analysts describe as a geopolitical premium. Multiple simultaneous stress points, sanctions architecture, reserve currency fragmentation, bilateral trade settlement in non-dollar terms, are all contributing to structural demand from sovereign entities. This is not speculative demand. Central banks do not buy gold for short-term trades. They accumulate for reserve diversification. And the pace of that accumulation over the past 8 quarters has been unprecedented in the modern era. One possible outcome is that this sovereign demand creates a permanent floor under gold that did not exist in previous cycles. That changes the downside scenario materially. But sovereign demand alone does not drive price to $10,000. For that, you need a broader liquidity event or a currency credibility crisis. We will come back to that. The United States debt trajectory is not a secret. It is in the public data. The Congressional Budget Office projections, the Treasury issuance calendar, the debt to GDP ratios, all of this is accessible. What markets are currently trying to price is whether the US dollar maintains its reserve currency status through this debt expansion, or whether the accumulation reaches a level where confidence begins to erode structurally. If dollar confidence erodes, not collapses, but erodes, gold priced in dollars goes significantly higher simply due to the denominator effect. You are not necessarily getting richer in real terms. You are watching the measuring stick shrink. This dynamic is subtle, and it is one reason why gold at $10,000 is not as mathematically extreme as it sounds, when you account for what $10,000 gold would imply about dollar purchasing power. Let us talk about how large institutions are actually positioned, because this is where the next 48-hour window becomes critical. Options expiry mechanics in gold are frequently misunderstood by retail investors. Large institutions use options not only for directional speculation, but for hedging physical inventory, managing delivery risk, and executing structured products for clients. When open interest clusters around specific strike prices, and right now there is significant options clustering around the $5,000 level, market makers have to manage their delta exposure dynamically. This creates mechanical price behavior that can look like manipulation, but is actually just the mathematics of options hedging. What this means practically: at $5,000, gold is sitting on a major psychological and technical level that also happens to be a significant options strike cluster. In the short term, price action around this level may be more about mechanics than fundamentals. Breaking cleanly above 5,000 with conviction, on volume, with physical delivery data confirming, would suggest that the options mechanics are not suppressing the move, and that real demand is driving price. That is the bullish read. Failure to hold 5,000, particularly if accompanied by a spike in COMEX delivery failures or a sharp move in managed money unwinding, would suggest the mechanical support is breaking down. That is, the early warning of the bull trap scenario. Several large financial institutions have quietly shifted their internal gold price targets upward over the past 2 quarters. Some have revised upward more than once. This is notable because institutional target revisions are typically conservative. Banks do not want to look like they are chasing a trend. When institutions raise targets multiple times in a short window, it often reflects real positioning changes behind the scenes. The public target is the acknowledgement. The actual positioning typically preceded it. Data suggests that the smart money began accumulating meaningful gold exposure significantly below current prices. They are not initiating new positions at 5,000. They are managing existing positions and deciding whether to hold through volatility or take partial profits. That profit-taking dynamic is the primary source of near-term selling pressure, not bearish conviction, but rational profit management. The divergence between Eastern and Western gold markets is one of the most structurally significant developments in the precious metals space in decades. Shanghai Gold Exchange pricing, the SGE premium over London spot, physical delivery volumes out of Asian exchanges, all of these metrics are telling a different story from Western futures markets. Asian physical buyers, retail, institutional, and sovereign, have demonstrated sustained price insensitivity at levels that would historically have caused demand destruction. In prior cycles, when gold crossed major thresholds, Asian retail demand softened. Buyers waited for pullbacks. That behavior has changed. Data suggests a structural shift in Asian accumulation patterns, possibly driven by currency concerns, property market stress redirecting savings, and a generational shift in how wealth is stored. This Eastern bid under the market is a variable that Western futures models did not adequately weight in their prior frameworks. It is a genuine new input into the supply-demand equation. On the supply side, gold mining output has been structurally constrained. New major discoveries are rare. Existing mine grades have declined. All-in sustaining costs have risen significantly, creating a higher fundamental floor for price relative to prior decades. The energy cost embedded in gold mining, the fact that it takes substantial real-world resources to extract an ounce from the ground, means that the cost of production is itself tied to the inflation dynamic. As energy and labor costs rise, the floor under gold mining economics rises with it. This is not a near-term catalyst, but it is part of the structural backdrop that makes the bear case for sub-3,000 gold increasingly difficult to construct on fundamentals alone. The most frequently cited historical parallel for the current environment is the 1970s. Elevated inflation, geopolitical instability, dollar credibility questions following the Nixon shock and the closure of the gold window. From 1971 to 1980, gold went from $35 to $850 per ounce, a 24-fold increase. But here's what the simple comparison misses. Gold did not move in a straight line. There were 2 distinct bull phases separated by a 47% correction. Investors who bought at the peak of the first phase and held through the correction experienced nearly 2 years of severe drawdown before the second, larger move began. The psychology of that period is critical context. Many investors who were right about the fundamental thesis still lost money because they could not tolerate the intermediate volatility. If we are in an analogous cycle today, the question is not just whether gold reaches $10,000. The question is what path it takes, and whether that path is navigable for investors with finite risk tolerance and non-infinite time horizons. The 2011 peak at approximately $1,900 is the other instructive comparison. Gold corrected 45% from that peak and did not reclaim it for over a decade. The 2011 peak was characterized by extremely elevated retail sentiment, significant ETF inflows chasing momentum, and, critically, a subsequent shift in Fed policy toward real rate normalization that destroyed the monetary case for gold. Are any of those conditions present today? Retail sentiment is elevated, but not at the same euphoric extreme. ETF inflows have been significant, but physical demand from Eastern buyers is providing a different kind of support. And Fed policy normalization is constrained by the debt load in ways it was not in 2011. The parallels are imperfect, but the lesson is structural. Extended runs in gold always encounter a point where the marginal buyer runs out before the next catalyst arrives. The question is whether we are at that point now. Let me give you the bear case with full intellectual honesty, because anyone who presents only one side of this trade is not doing analysis. They are doing advocacy. The bearish scenario for gold at $5,000 goes like this. The current price reflects a premium for geopolitical risk and dollar skepticism that may not be permanent. If geopolitical tensions de-escalate, and history shows that tensions always eventually de-escalate, at least temporarily, the risk premium in gold deflates. If the Federal Reserve achieves any credible re-anchoring of inflation expectations, even without full victory, real rates move in a direction that reduces the monetary case for gold. If the US dollar strengthens against a basket of currencies due to relative economic outperformance, which is a plausible scenario if European or Chinese economic weakness accelerates, dollar-priced gold faces a mathematical headwind. And perhaps most importantly, if the managed money long position on COMEX unwinds, whether due to margin calls, a macro shock, or simply profit-taking, the mechanical selling could push price well below fundamental support levels in a short time window. Not because gold's value has changed, but because leveraged positioning unwinds do not respect fundamentals in the short term. In a bear scenario, gold at $5,000 could correct to $3,500 to $4,000 without breaking the longer-term structural case. That would still be a significant drawdown, and it would test the conviction of every investor currently positioned long. The bear case is not that gold is worthless. The bear case is that the current price is running ahead of the catalyst timeline, and that the market needs a rest before the next leg, if a next leg comes. That is a rational, data-supported scenario. Anyone dismissing it is not thinking clearly. Let me give you the rapid recap. COMEX structure. Managed money longs are elevated, creating mechanical fragility. Commercial positioning is not at historic short extremes, which is a nuance in favor of bulls. Physical versus paper. COMEX registered inventory under drawdown. Physical delivery demand elevated. This supports the structural bull case but requires monitoring. Gold-silver ratio. Divergence from prior bull market patterns. Resolution of this divergence is a key confirming or disconfirming signal. Macro. Fed in stagflationary bind. Real rates still supportive of gold. Any shift toward positive real rates is the primary macro headwind. Institutional behavior. Smart money is managing existing longs, not initiating at current levels. Options mechanics at $5,000 create short-term volatility risk. East-west divergence. Eastern physical demand is a structural new input. It creates a higher floor but does not by itself drive price to $10,000. Historical context. 1970s and 2011 both offer warnings about intermediate corrections within longer cycles. Path matters as much as destination. Bearish case. Geopolitical de-escalation, dollar strength, managed money unwind, or real rate normalization. Any of these could trigger a significant correction without breaking the long-term thesis. The scenario matrix conclusion. The road to $10,000 is possible. It is not guaranteed. And the next 48 hours of data, FOMC communication, physical delivery signals, options expiry behavior, will provide meaningful information about which path is more probable. I want to hear your analysis, not your emotion. In the comment section, tell me this. Based on what you just heard, which scenario do you think the data currently favors more? Bull continuation toward 10,000, or a significant corrective phase before any further advance? Give me your reasoning, not just a number. Your reasoning. That is the only comment worth leaving on this channel. If you want to subscribe to this channel, understand what you are subscribing to. This is not a channel that tells you what to buy or sell. This is not a channel that will make you feel comfortable about your existing positions. This is a channel that will show you how to read structural data, think in scenarios, and separate signal from noise in financial markets. If that is what you came here for, subscribe. If you are looking for someone to confirm your bias, there are plenty of channels that will do that for free. The bell notification exists. Use it if this kind of analysis is what you actually want more of. Gold at $5,000 is not a destination. It is a question. The market is asking whether the world's monetary architecture is undergoing a structural transition or simply experiencing an extended panic premium. The answer will not come from sentiment. It will come from data. Analyze the data. Think independently. OG Anna AG. Out.